James Knightley is Chief International Economist at ING. He's joining us now to take some questions. James, good to have you with us here. Thanks very much. In a way, a lot to digest, but little change, right, from what we already know. And it's interesting always how sort of narratives move and then something which would have been considered. So, for example, I mean, we were talking about rate cuts getting postponed, and now there was this element of a possibility of a hike. Will they refer to it? That started to creep into the market. And then now overnight, when they did not sort of lean that way at all, it's being seen as a positive. James, so your sense?
Yeah, no, we've seen some interesting moves in financial markets through the afternoon in the United States. Initially, the fact that we didn't see any consideration of the possibility of a rate hike anytime soon. Powell saying that he would need persuasive evidence to justify any action, and that he thinks policy is in a good place. So that provided a lot of relief. That there's no likelihood of a rate hike unless the data comes in even stronger than what we've been seeing. So there's still a bias to ease, but that when the ease is still the question mark. And again, given the data has been so strong, we've seen the past 3 months, inflation's coming at double the rate we need to see. The economy's added over 800,000 jobs in the first 3 months of the year, and the consumer is still spending. So there's little prospect of an imminent rate cut, but that rate hike scenario does appear to have taken off the table.
James, so much can change in a matter of weeks, right? As Prashant mentioned, that we were all talking about whether we're still getting 3 cuts this year or not. So now saying, okay, at least there's no hike. But my question is really that, do you think markets have sufficiently digested this pivot? I mean, the equity markets in the US, for instance, are down about 4.5% in the last 1 month. Bond yields have been very, very range bound. Do you think this is how things will remain for the going couple of months? We're just in a bit of a limbo with respect to monetary policy.
I think it's just purely down to the data now. We know the Fed's position, that they would like to cut if they can cut. And that's the basic narrative I think we've been getting from Jerome Powell and the rest of his team. Now, as I say, we need the data. And it's not just 1 month or 2 months worth of data, to be justifying a rate cut. Well, I think we need to see 3 or 4 months. So that would mean September really is the earliest opportunity for a rate cut. I think we'd need to see at least 3 inflation prints, core inflation prints coming in at 0.2. Remember, we've been coming in at 0.4 for the last 3 months. And I think also we'd need to see a weakening in the labour market as well. The unemployment rate's currently just 3.8%. I think we'd need to see the unemployment rate creeping up above 4, probably towards 4.2%. by September for them to actually move at that September FOMC meeting. So it is, I think, really down to the data and seeing clear momentum shifts relative to what we've seen in the first 3 months of the year, which has been very, very strong.
Hi, James. Morning. Good to see you in. James, so what are you factoring in then? September is going to be the crucial meet. Do you believe we'll get a couple of rate cuts going by the data that we already have on the table for 2024? And what about 2025? And also in that sort of a backdrop, we are looking inward out here. What does an emerging market central bank like India, what does the RBI do from here on? We'll have to wait to see what the Fed does, I'm guessing.
Yeah, I think, as I mentioned, I think the Fed is inclined to cut if it can. But we need to see the data prints coming through. I think we will. We're looking at a clear divergence between what official activity data is saying and official jobs data is saying and what business surveys are saying. Business surveys are considerably weaker. We're going to get more business survey evidence on the labour market over the next couple of days from the Institute of Supply Management and the National Federation for Independent Businesses. I think that is still pointing to a clear weakening in the job creation story in the United States. And I think that we will get the unemployment rate ticking higher. The key question is that inflation print. We need to see inflation coming down. Now, we still think 75 basis points is on the table. We're a little bit more aggressive than the market, but not hugely so. But for next year, of course, we've got the election to consider as well, of the presidential election. And if we get a President Trump being elected, the dynamics could shift considerably because, of course, he is proposing tax cuts, corporates and potentially households. He's also talking about tariff increases not just for China, but for India, for the UK, for Germany, for Canada, for everyone. So this is going to be something that really could change the situation. And if we see ongoing large fiscal deficits in an environment where inflationary pressures are building because of tariff hikes, and if we do see tax cuts in the United States that support domestic demand, then that would really change the story on the outlook for the Fed next year quite considerably, because the Fed will be highly unlikely to cut meaningfully if that is the scenario.
Absolutely. And that's an interesting point you put on the table with respect to tariff hikes on sort of guessing what's happening to inflation. But James, on the basics as well, every commodity from cocoa to gold to metals in between, everything has been shooting higher. And these are multi-year highs that we're talking about. Oil has given up a little bit from the top. But what is your base case projection on inflation itself?
As I said, we do think it will moderate. The US is largely a service sector economy. Manufacturing is less than 10% of US economic output. So, yes, there are price pressures in those commodity markets that are impacting manufacturers. But as we saw with the Institute of Supply Management, the sector is contracting. Does the sector have pricing power to actually pass that on to consumers and other businesses? What's more important for US inflation and keeping inflation sustained is what happens to wage pressures. Because, as I say, in a service sector economy, the biggest cost input is the cost of labor. And if the jobs market is weakening, wage pressures are becoming more subdued, then there's perhaps less risk of inflation staying high for a prolonged period of time into next year.
All right, James, we'll leave it on that note for this morning. Great talking to you. Thank you so much for staying up and taking all our questions today. Appreciate your view.